Hello, everyone, and welcome into CrushTheStreet.com. We got a special interview today, kind of an emergency briefing here because, look, I'm watching my screen right now, and the Dow has plunged more than 500 points. It's January 20th, 2016, and the stock markets are continuing to melt down. The Dow Jones is below 15,500. The S&P is getting close to 1,800, 1,823 at the moment. And crude oil is in the $26 range, down 6.5% for the day. So I got a special guest on the line. His name is Nicholas Green of FMT Advisory. And we're going to talk about the economy. And he's got some interesting assessments on oil and just the precious metals. And I really wanted to spotlight him today. And let's get right into it. Nicholas, thanks for joining me.
Thank you so much for having me on your show, Kenny. It's a pleasure to be here.
Nick, like I just said, oil just crashed below $26 a barrel. We've seen Iranian sanctions lifted, which has actually added more supply to the market to some extent, and we saw that move, from above 30 down to below 30 after some of that news. What is your assessment on the economy and on how it relates to oil at the moment?
Hey, do you remember what we did the last time we met in California and we went hiking and what we saw?
I remember we saw a bear.
We saw bears. Remember, we saw a bear and their little cubs while we were hiking up in the California mountains.
We did see a bear.
And that is what we see in every single market across the world, in every single country. And it's pure carnage out there. And we can all look towards the Federal Reserve and the United States government and their narrative that we were under this grand recovery and all kind of wake up from our sort of complacency and realize there was never a recovery. It was swept under the rug by $3.5 trillion in Fed monetary expansion and $9 trillion in additional debt that the United States government has layered on since 2009. And the Fed raised interest rates by a scant 25 basis points off the zero bound after 7 years. And that small interest rate increase has made those bears that we saw up in the California mountains look friendly.
So, Nick, what are your thoughts as it relates to oil? Is oil going to continue going to 20 and below, or what's your more long-term assessment on what we might see in oil? I know you've done a lot of research on it, and it's important, and I wanted you to be able to share that with everyone.
Sure. So one of the things that I came to recognize is one of the things the Federal Reserve keeps saying over and over and over again is that low oil prices, while it may affect CPI, the core price inflation that the Fed looks at, while it may spill over there a little bit, they believe that it will be transitory. Only are transitory oil prices don't persist. That will be the only way the core CPI doesn't keep decelerating. The CPI print just came out today and it decelerated again. So again, the Fed raised rates by a quarter basis point, and you have their core price inflation index decelerating. So they're not even at their mandate, now it's decelerating. And so the Fed is in big trouble here because the Fed, to save face, they need some kind of inflation here. This looks like one of the most historic interest rate blunder hikes in history so far. And the Fed, being a self-serving entity and private corporation, they're going to need to save face. So I think either the physical markets in oil eventually help them out, or they will need to get some help from some big trading partners at some big trading firms to, ignite the algo farms. But yeah, the energy markets have fallen from 106 to about 26.27 today. That's a 70+% correction from top to bottom. And in the 2008-2009 collapse, the housing bubble and subsequent collapse, oil fell from top to bottom about 77%. So from top to bottom, oil has collapsed just about the same amount as it did in 2008-2009. And these prices are completely long-term and sustainable, but the ramifications through the economy are enormous. And so there's going to be a lot of people shooting for higher energy prices here over the next year or two. And the fundamentals of oil are just fascinating. We can get to that in a moment.
Yeah, no, let's talk about it. I mean, there's a lot of uncertainty out there with obviously oil trading in the $26 range as we speak. Shale oil companies are not profitable, and countries around the world who depend on oil, who don't necessarily rely on shale, don't have the money it takes to run their economies. So there's a lot of global geopolitical problems with oil at this price. And so what are your thoughts on kind of what we are likely to see going forward?
Well, the near term is uncertain, and I actually just wrote a recent article that's posted on the website at fmtadvisory.com. It's titled "Sleepwalking into a Major Oil Supply Shocker or Shock." And essentially, in the article I said I believe that energy at some point bottoms sometime between now and May. This is a seasonal build period for the storage facilities of oil. For Cushing and all the other storage facilities, and so the refineries do a lot of maintenance capex, and that creates overflow of oil into the facilities while they're working on their maintenance facilities, and also the slower time of year for travel. So those two things create a little bit of an increase in storage facilities, which is traditional for this time of year, and I think that will create some, that has been and will create some additional noise in the energy market, and so so my base case has been oil probably, in my mind, finds a bottom somewhere between now and May. What that exact bottom is, I'm not sure. It's so I set this around oil $30 a barrel, and now it's at 26.27. So I'm not sure if it's bottoming now, if it bottoms at 20, or suddenly some mysterious forces comes into the futures markets and oil starts getting a bid. But one thing is certain, barring a Great Depression, oil at this point is really, really long-term unsustainable. The shale producers weren't producing profits when oil was at $70, $80, $90, $100 a barrel. They're clearly not producing profits now. And that was where the big increase in oil came from. In 2007, 2008, the United States was pumping about 5 million barrels of oil per day. That increased all the way up to 9.6 million barrels of oil per day until recently. Now it's down to 9 million barrels of oil per day. And so it's coming down. And there's $200+ billion in capital expenditure cuts, which, just for your audience that aren't in tune with the sort of business jargon, is if you're running a business and you're not making money and you need to tighten the screws, the last thing you're going to do is keep spending money that you don't, especially that you don't have, on new projects and growing your production. And so when you have $200+ billion in capital expenditure cuts across the industry, that's going to create. We've gone from 9.6 billion down to about 9 billion, or a million barrels of oil per day being produced. That's going to keep coming down with 200+ billion in capex cuts. That's a guarantee to keep coming down. On top of it, you have a thing called CATR, the compounded average growth rate, a decline rate of oil wells. And so once you plug in and you start pulling oil out of a well, there's a natural decline rate. It's, not each well has an infinite amount of oil, so there's a natural decline rate. And based on studies by the EIA, IEA, ExxonMobil, BP, and some of the other big stalwarts, the CATR rate is about 5.8%, which means over the next year or two, you're looking at huge production coming offline just based on the Qatar, and with no increase in production and capex spending, you're going to see 10 to 12 million barrels of oil per day come offline in the next couple of years, when we're only producing in excess of a little over a million today, about 1.5 million.
So, Nicholas, right now we're looking at, and it's all over the headlines, that we have this major supply glut, and you're talking about supply coming off of the market. Can you kind of give us an idea of how bad or how mild this supply glut really is? And I think that'll give us an idea of what we can expect going forward.
Sure. So right now we have an excess supply of about 1.5 million barrels of oil per day worldwide. That's come down significantly already over the last year. When you consider 1.5 million barrels of oil per day, and then you add in the Qatar rate, the natural decline rate of wells, and then you add in the idea that 200 plus billion in capital expenditure cuts are coming to the oil and energy industry, that's simply not going to be enough production to offset the 1.5 million. So we need to replace 5 to 6 million barrels of oil per day over the coming year, just to keep the wheel spinning on current production at a total of 96 million barrels of oil per day. Not going to happen. It's not going to happen with the capex spending and with the Qatar rate. So what's going to happen is, OPEC recently said it too, is they see the oil supply-demand market come into balance this year. I think that if oil stays low, my big point is if it stays low like this for a prolonged period of time, you're going to see 1973, 1974 style oil supply shocks, which during 73, 74, during the oil embargo, oil went from $3 a barrel to $12 a barrel for a massive 300% return. Gold, silver followed with like returns, while the S&P dropped 500%. My point is and Ray Dalio has been on, all over the news this morning on TV, CNBC, and Davos, and he said something very interesting. He said that all assets are correlated right now, and all assets are getting mauled. So if all assets are correlated and all assets are getting mauled, if it continues this way, we will head to the next Great Depression. So not only does he not see, this is the largest hedge fund manager in the world. They have 155 billion in assets. They have 15 non-correlated assets. They're about all-weather investing and balanced. If anybody knows about assets all being correlated and going down, it would be them. And so when you hear a gentleman of Ray Dalio's nature talk about balanced portfolios and all weather and everything being correlated and going down at once, and that will end up in the Great Depression, you better lift up your ears and listen. And so what he said was, the Fed will more likely not only not raise interest rates, but their next move will probably be QE4. And I would agree with that, because the person who has the biggest problem with all asset prices declining, other than cash and long-term treasuries, the only entities that have the biggest worry of all, versus people that are worried about their portfolios or managing their assets, the bigger worry is not for them or us. The bigger worry would be for the United States government and the Federal Reserve, because they cannot afford a Great Depression. So the United States has added on $9 trillion in debt since 2009.
Nicholas, and this kind of correlates to what you're talking about and kind of what we were talking about before the interview. What would it take for oil to actually go back to $100 a barrel? And it wouldn't be a fundamental way, but I get your thoughts on how you potentially see oil going back to $100 a barrel. Whether it's in the next 2-3 years, 5 years, what would it take?
Well, my prediction isn't that it's going to $100 a barrel. I think you need to remain rather flexible on what the Fed is doing. The only way it gets back to $100 a barrel, because we have proven that $100 a barrel is hard to afford in an over debt saturated market. But one of the key things you really need to be looking for is the Fed to stabilize all assets. Now, I'm not somebody who's for central bank intervention, and I'm not somebody for central planning our economy. The problem is they're so knee deep with the things they've instituted over the last 20 years, and we've seen it big time in the last 7 years. But they've been so knee deep in intervening in markets nonstop that's why you're seeing these massive moves on a mere quarter basis point rises, because they've been involved for so long that any slight tweaking, any slight tightening, and it's just basically carnage across the board. And so we can all look to the Federal Reserve and the United States government and thank them for this. But the point is this: every 10% drop in the market, the Fed, the U.S. government, the U.S. Treasury loses about 5% in tax revenues. They never fix their structural deficits, the unfunded liabilities, on top of the official net debt that has gone up, $9 trillion. And so there's no doubt that this gets bad enough. It's like squeezing an arm until they cry uncle, and that's what these markets are doing to the Fed. And the Fed at some point will be praying for higher oil prices, because they're the ones who said higher oil prices is just transitory effect on the core price index. And so it's very interesting, but just sit back and relax and enjoy the show with some popcorn, and it's going to be fun.
Something worth noting is that gold is actually up today on a major down day in the market. It's up $17. It's just over $1,100 a barrel. I mean, I wouldn't call that a recovery by any means. Silver is over $14 an ounce on the spot price. And correlated to oil, you've done some research about potentially what we could see between the issues we're having with oil and what we can expect with precious metals. Let's get your thoughts on that, Nick.
Yeah, great question. Remember the very first interview we did on your platform at Crush the Street was on the gold Dow
gold ratio. That's right.
And the bottom line of that whole interview was that it wasn't all about gold, as you said. It wasn't all about the Dow. What it was a financial metric. It was it's a metric to kind of gauge how financialized the economy was. And remember what I said at that point. I said history is 100% of your time. Never from those valuation metrics would you be lost money if you were short the market and long gold. And so sure enough, here we are today. Had you been short the market and long gold, you'd be hanging in there pretty darn good right now, right? But I also said you can't put $1 million, $500,000 short the market and $500,000 long gold. So you need to, keep cash. You need to stay balanced. And you need to keep perspective. And that was the whole point of that Dow Gold discussion, was how over financialized the markets were. And so now you're seeing that the financialization of the market is coming out a little bit, and it's coming out because the buybacks with companies taking on debt is being taken away a little bit. And on top of it, you're seeing the Russell 2000, which is the Fed's sort of metric. So that's a financial metric based on small capitalization. It's down 26-27% since the Fed. So financialization come out of the market, and real assets like gold are starting to sort of show their shine and their luster again. And if you go back to that metric again to like 1929, 1970s, and 2000, in the 70s and 2000 ended up also doing very, very well at some point was energy, right? Energy, materials, and those types of things. So the only way energy and materials don't also end up doing well is if the Fed lets this literally slip into the next Great Depression. And so you don't want to be going 100% long in energy by any stretch of the imagination. For smaller accounts, you can wait. For bigger accounts, you want to just scale in slightly. But because history's on your side here with real assets, things like gold, silver, and oil. Silver, I believe, will either start to move a little bit before, with gold, or silver will eventually move with oil when, this despotic madmen in charge do everything in their nature, because it's human nature to do something versus to sit back and watch it all implode. Once they start doing something, I believe energy, finds that bottom sometimes between now and May, and then it starts to rise at some point. And I think that will be good for the precious metals because there's a long correlation. In fact, I talked to one of our mutual friends, Steve St. Angelo, and he made a good point that he was one of the few people who's charted the price of oil and silver all the way back to 1900. And the shocking revelation that he came across is that they're correlated nearly 1-1. So if you own oil, you basically own silver, or vice versa. And so there's a strong correlation there. And so
but he does think, or he's, his analysis is showing that it might diverge going forward. That it's been correlated, but then oil might stay down and precious metals will go up, and that correlation will disconnect.
Well, I don't want to speak for him. He does think that's a possibility that they could decouple, but he also does think it's a possibility that it's possible that you can see an energy oil supply problem at some point, and then a huge spike in the price of oil, even though we can't afford it if the Fed is sending out checks and printing enough money. As he said, he thinks what would work in that case is they're literally sending physical checks to addresses.
Nothing would surprise me at this point.
But yeah, so I don't want to speak for him, but yeah, he did say that he thinks they could decouple, but he also thinks that given enough oomph from the dictators in charge, that you could see much higher oil prices, and he doesn't discount the idea of that happening either. He's very, very intelligent man, and he has a lot of great data. So it was a pleasure speaking with him. It was really enjoyable. But yeah, but anyways, he goes back to 1900 and shows that oil and silver basically go hand in hand for over decades and decades and decades. And I actually don't think I think it could decouple short term. You've seen it decouple short term, but look, the decoupling is back. Now they're back in line with each other. Now that first gold and silver went down, oil was hanging in there. Gold and silver then stabilized. Now energy has crashed down to where gold and silver is, and so basically they've now non-decoupled and they're back into a heavy correlation. And so I think the correlations will persist, and I think it's energy. Gold for the conservative investor should definitely own some physical gold here as a savings vehicle, not as an investment. I see it as a savings vehicle when gold is undervalued to the monetary base or showing over financialization on the Dow gold ratio. But I also believe at some point energy. I haven't been an energy bull, as everybody knows me. It's something I'm turning bullish on, and I believe that over the next year or two, it's very similar to the banking system in 2009, where investing in banks seemed like an insane idea, but the Fed told you what they were going to do. They were going to buy equity in the banks and leave equity holders hold. You have the Fed behind your back. I believe, as I posted on an article on the website recently, that at some point in energy, you're going to have the Fed 100% at your back. Because the Fed, to remain credible at all, is going to need higher energy prices, period.
Well, Nick, you've been extremely credible. When we did do that interview, the Dow gold ratio was around 16, and now the Dow to gold ratio is 14, and we are seeing the collapse of financialized assets and gold holding up. So that's excellent analysis on that, and it's really interesting analysis on what we might see with energy as it correlates to precious metals. So with that, was there anything else that you wanted to share with our audience that we didn't get to yet?
I would just sit back, relax, stay balanced. Don't be worried out there. Let the Fed be worried, because that's the entity that should be worried. In fact, that's one of the things he said is he has heard some inside scoops that the Fed is sitting back just completely petrified, which they should be. And the United States government should start to be very, very concerned with their tax revenues, because let's face it, when we start blowing up $1 trillion plus cash deficits again, on top of our already big pile of debt. Remember, the United States is supposed to be the beacon of strength around the world, and here we are in quarter basis point rise.
The powers, the powers are losing control of the system. There is no control with markets moving the way they are, and they're having a really hard time keeping it in the green.
Yes, and so stay nimble and stay flexible. But yeah, I don't think I have too much more to add.
Good. Well, again, thank you so much for coming on the show with me today. Nicholas, if people wanted to reach out to you and learn more about what they do, how would they get in contact with you for you to kind of go over with them your assessment of their portfolio and their specific situation?
Well, they can call me toll free at 888-649-6556, or they can just come on over to fmtadvisory.com and sign up for our email. And I'm also available through email contact submission on our website, so welcome your inquiries.
Nicholas, thanks so much for coming on with me today. It's always a pleasure talking with you.
Thank you for having me, Kenny. We'll talk soon.